Treasury management in an organization involves a myriad of functions from investing surplus funds to project financing and cash flow management. To put it simply, the Treasury is responsible for ensuring that the company's funds are efficiently managed. As a guardian of a company's liquidity position, the Treasury Department must actively be involved in decisions that affect the availability of funds, even something as operational as extending the credit period to customers. Typically in startups, most department heads would wear the hat of a treasurer while making decisions that impact cash availability, indicating the importance of the function across departments. In larger companies or late-stage startups, treasury management is a more mature role with well-defined responsibilities. In such companies, there usually exists a team that performs treasury functions. The importance of efficient treasury management cannot be overstated. From being an enabler of smooth business operations to contributing to shareholder value, the treasury function can be a key partner in an organization's growth. An example of this was seen in Reliance Industries Limited. In FY 2014-15, the company saw a 50% increase in current investments. The company earned an EBITDA of 8,335 crores from treasury operations, higher than any other line of business. In this particular year, RIL's aggressive treasury strategy enabled the company to maximize shareholder return even when the company was not able to create significant wealth for its shareholders from its existing lines of business. In well-established companies, the Treasury Department may be faced with the added challenge of managing multiple currencies. This would mean risking financial performance due to adverse movements in exchange rates, compliance burden due to different regulatory bodies involved, and other executional challenges. It is estimated that forex risks cost US companies a stunning $100 billion every year purely based on incurred losses. One simple yet effective method to manage this risk is hedging using a forward contract. For example, say a company exporting goods has a receivable of $100 in 3 months. The rupee value of this sale made would depend on the appreciation or depreciation of the rupee, which has an impact on both the cash position of the company and the realized revenue. To hedge this, the company can enter into a forward contract to sell the dollars that they would receive 3 months hence. Once the sales proceeds are realized, the company can sell the dollars to honor the forward contract and insulate itself from any forex risk. There are multiple mechanisms in which hedging can happen, but the Treasury here is responsible for understanding and assessing the quantum of foreign exchange risk that the company can take and accordingly hedge only those transactions that would have a material impact on the cash flow of the business. In a group of companies, multiple entities within the group may require cash, and instead of each of the companies reaching out to their own banking partners, the group creates something called a cash pool, which can be used to satisfy the working capital requirements of the group companies. The mechanism involves consolidating the excess capital across all companies into one entity and providing short-term unsecured debt to these group companies. The interest rates are usually benchmarked to similar arrangements, and the borrowing company has flexibility in terms of repayment tenures. The lending companies in the group obtain a mechanism to invest their surplus cash in avenues that provide market-based returns. Most startups need to keep an eye out for the number of months left in their runway. Hence, for a startup, cash management and regular cash budgeting are vital to understanding the expected liquidity position of the company. One important metric is the cash-to-cash cycle, also known as cash conversion cycle or operating cycle, which refers to the days between the purchase of goods from a supplier to the date of collection of sales proceeds from customers. The cash conversion cycle is made up of days sales that are outstanding, DSO, days inventory that is outstanding, DIO, less the days payables that remain outstanding, DPO. DSO refers to the period between when the sales invoice is raised to the date of collection of sales proceeds. DIO is the number of days the company holds the inventory before actually making a sale, and DPO refers to the number of days between when the creditors raise the invoice to when the payment is made and the account is settled. In all cases, businesses strive to reduce their cash conversion cycle. This can be done by either reducing the DSO and DIO or increasing the DPO. efficient inventory management can help reduce the DIO, and understanding concepts like the economic order quantity would help the company achieve this outcome. With respect to DSO days, in many cases, companies try to incentivize prompt payments with discounts. However, an overly generous discount scheme may push the cost of collection up to the cost of additional financing. The importance of efficient treasury management was clearly displayed in the Silicon Valley Bank collapse. As a custodian, Silicon Valley banks strive to ensure liquidity to startups, thereby making it an attractive alternative for deposits. However, the bank's failure in treasury operations also has a trickle-down effect on the operations of startups maintaining deposits with such banks. Startups should strive to diversify their deposits, at the same time ensuring liquidity and security. With the rise of emerging technologies like generative AI, blockchain, etc., a treasury operation could soon look very different. Here are some interesting developments. Virtual accounts with convenient and easy verification processes allow the creation of escrow accounts linked to one master account operated by the company. This enables accurate cash management and ensures that designated funds are maintained for specific end-use targets. With the rise of generative AI, it comes as a little surprise that cash flow forecasting would be a prime candidate for AI-led enhancements. The accuracy with which a company can predict its cash surplus will ensure smooth business functioning, and generative AI has come a long way in making this more data-driven. Blockchain technology has proven use cases in treasury management, particularly with the rise of central bank digital currencies like the digital rupee and tokenization. Letters of credit and bank guarantees can be fully built on private blockchains to ensure the integrity of transactions between buyers and sellers. In every organization, the treasury needs to be in touch with business realities while making decisions that impact the cash position, thus making it a hugely collaborative exercise. Think of it like the kitman of a sports team. Successful operation makes no noise, but any mishaps are there for the world to see. Some people might pose a question on the replaceability of this function, citing its supporting nature and the rapid advancements in technology. We believe that treasury decisions are built upon choosing the option which ensures efficient capital management. It requires repeatedly making correct decisions, high attention to detail, good communication channels with decision-making authorities, and the trust of the organization's leadership. Most leaders in an organization should pay close attention to the people making these decisions. Be it a startup where this role is played by multiple people, or a larger company with a well-established process. The characteristics mentioned are vital. During testing times for a company, a solid treasury function can make all the difference.